Hello and welcome to Need to Know, your weekly investment podcast brought to you by the experts at Coutts. I'm Sarah Muir and I'm joined as always by David Broomfield. I'm very pleased to welcome back friend of Need to Know and regular guest, US equity expert Howard Sparks. Hello, both of you, both David and Howard.
Hello.
Hi, Sarah.
Howard, you're not going to be talking US equities specifically today, are you? You wanted to look at investing styles. Now, there are more than three investing styles, but the rules of Need to Know are that we only look at three things. So what are we going to focus on in today's Need to Know?
Well, thanks, Sarah. Thanks for inviting me back. It's great to be here. I was going to talk about three investment styles. My three things you need to know. First of all, value. Buying cheap companies is hard to do. Secondly, quality investing. Buying great companies is hard to do.
Okay.
And then finally, momentum. Buying companies that have gone up a lot is hard to do. So anyway, they're my three things.
Okay. So what we're saying is investing is hard, yeah?
Yeah, always.
It's not easy. Okay. All right then. So value investing. No, you said buying bad companies. Now, it's not necessarily, we're not talking about buying bad companies, are we, when we engage in value investing?
No, I mean, strictly value investing is the approach of buying companies at distressed valuations in the hope that valuations will recover back to fair value. I do remember, I think value is in the eye of the beholder. So I do remember when I started my career, there was a guy called Bill Miller who used to run the Legg Mason Value Trust, and that was just full of loads of internet companies, so that wasn't value at all. But yeah, it's kind of cheap companies, distressed companies that have, for one reason or another, they've hit hard times. That's how I would describe value investing.
Is it fair to say that they're companies that were probably once good and have kind of slightly fallen from grace? And
can be, yeah.
But it could also be companies that have never perhaps achieved their full potential.
I guess so. Yes. Yeah. I guess so. But I would say probably more lean to those companies that maybe the valuation has fallen too far. So they've, something's happened. The valuation has fallen, and value investors will come in just as things look attractive to them.
So isn't this one of the interesting things about how value investing has evolved? Like if you go and look at the history of it, right? Which is it's the oldest style of investing, certainly in modern times. So it goes back to sort of the 1920s to Benjamin Graham and David Dodd. And if you sort of read their seminal book, Security Analysis, from the 1930s, it's a very quantitative approach. So, those things you just mentioned, Howard, they're very sort of quantitative metrics. But when you look at value investors today and you consider things like activist activity and all those, it seems like there's a more qualitative angle that's coming in now in recent times.
I guess so. Certainly with activists, they are looking for, they're looking to change something in order to generate a catalyst for that valuation to rebound, right?
And I guess if we, without wanting to mention individual company names, because you don't want to be seen to be giving recommendations, but if we think of the meme stock craze of, what was that, 18 months ago, that, I suppose, to an extent was value investing, wasn't it? When everybody piled into that particular...
Yeah, certainly it began as value investing. Certainly the Keith Gill on Reddit. Don't think we can say that what his Reddit handle is, but
definitely not safe for work.
Deep something value.
That's the one. So again, we're going to come back to this because I have a question in relation to this. Okay, so it's going to take quite a lot of research. We'll come to perhaps how that compares and contrasts with other investing styles. You're looking for something that's you identify as being below its intrinsic value. The expectation is that at some point it will go up in price, that other people will recognize what you have identified and the price will go up. So then does that mean then presumably you have to sell it once you make a reasonable profit on that original purchase? And is that perhaps where the challenge comes in?
Well, yeah, that's right. So anyone who's seen Bargain Hunt will know that you can buy something which looks incredibly cheap, but that's no guarantee that someone's going to want to buy it from you. And I think this is the challenge of value investing, really. That I think my old boss used to say that true value investing is looking across your portfolio and that making you want to be a little bit sick, because all these companies have kind of something wrong with them, but you're buying. This is the reason why you're buying them, because you expect whatever they're suffering from at the moment to change, and for that value to become realized. But I think you kind of touched on the point, which I guess is part of the challenge of value investing is time. And often the rebound in evaluation to its fair value can take many years, and as we know, institutional fund managers and their clients can be unforgiving of those fund managers who take a long time to perform. We were all subject to quarterly performance analysis, and that becomes really difficult for value investors who might be buying investments which won't perhaps yield a return for many years. As we know, valuation by itself is a pretty poor timing signal. There's no kind of cast iron rule that a valuation can only go so low and then it will bounce back. Cheap stocks can stay cheap for a very long time.
So I'm going to go right for the jugular then, Howard. So you said at the beginning it's really hard, and I think when we look back at what the last decade and a half of market returns, you can see that value investing just hasn't worked. And this idea of time horizon, I mean, I've got this theory based on the research that we've done here at Coutts and some of the work we're looking at with private markets, that perhaps the rise in private markets and now private markets have grown from 600 billion in 2000 to now over 13 trillion, and you have private equity investors taking good value companies private and holding them private for a long time, and perhaps that investable universe of value stocks that traditionally was on public markets, perhaps it isn't there anymore. And I tried really hard to find some academic research on this over the last couple of nights, and there isn't any. And I think maybe listeners out there can find it and send it to me. But I think there's something that's when you look at some of these private equity firms and their strategies, they're value investors, and maybe that's one reason. I don't know what you think.
Well, I was going to say, I mean, obviously you've talked about private markets. And we'll look at this probably when we look at the other styles as well. How important is the wider kind of macroeconomic backdrop, and how does that influence the success or failure of different styles? I mean, do they go in and out of favour? And we've talked about how perhaps value investing has gone slightly out of favour, but do they have periods where they work really well?
Yeah, they do. I mean, in response to what David was saying, I 100% agree. I mean, I think that if you talk about that time horizon, private equity has that time horizon. They don't have the same scrutiny that investors in public markets do. And certainly, I haven't seen any research, but intuitively, it does make sense that a lot of these value companies have been taken over by private. But yes, so where we can see, I mean, if we can judge value investors or value investments as companies with low, let's say, low price earnings ratios, value as a style performs really badly when you're going into some sort of economic downturn.
Okay.
And the reason for that, if you think about it, is if you've got companies which are just kind of clinging on in a normal economic environment, when that economic environment gets worse, then very quickly those companies can go from being priced for survival to being priced for extinction.
Yeah.
And so it is very challenging owning these stocks when you're going into a deteriorating economic environment. However, this works on, in reverse. So when you're coming out of a downturn, if you think, well, those companies which, they're almost ready to pull the plug, but then all of a sudden economic growth returns and they can come back, then that works in reverse. So you go from being priced for extinction to priced for survival, and very big changes in valuation multiples as a result.
Okay.
I would. I'm going to find the exception which disproves the rule. So, and there are value investors and there are value investors, right? So you've got your traditional value investors, and then you have people like Warren Buffett. Now, Warren Buffett, in an economic downturn with the kind of scale and reputation that he musters, can and has brokered deals in economic downturns, which the other perhaps value investors couldn't do. So, famously GM during the financial crisis, as an example. So I think, obviously every value investor has a slightly augmented or modified version of the original thesis. They bring their own take to it. But sorry, Sarah.
I was going to say, because didn't Warren Buffett, he was a student of Benjamin Graham at Columbia, wasn't he? So presumably he started out life. I mean, is he a value investor? Is he a quality investor? Or did he evolve from one to the other, or does he combine the two?
Well, I mean, I wouldn't argue with the broad consensus, which is the value investor. I mean, yes, there's little exceptions, but that's been the common thread throughout his investing career. Charlie Munger, his longtime partner as well, that's probably more known for his pithy aphorisms about investing, but they're effectively the same. I mean, it's Benjamin Graham. The names that come to mind: Benjamin Graham, Charlie Munger, Warren Buffett, Seth Klarman, people like that.
And didn't Warren Buffett say that buying assets for less than their intrinsic value is the only logical approach? Is that fair to say?
Yeah, he did. I mean, it's interesting because so much has changed over the career of these individuals, and in the last sort of 40 years of capital markets. You've got those traditional metrics which you could look at, like price to book ratios. There's an argument to say that's no longer effective, right? The changes in accounting practices, and it's not as straightforward perhaps as it once was. Information, not just by volume, but the kind of granularity you can get on a business, is very different than what it was half a century ago.
Okay, so Howard, in a nutshell then, value investing, we know it's buying assets for less than their intrinsic value. Why is that a good thing? It sounds like a bit of a no-brainer, but what are the pros and what are the cons? So just to summarize.
Yeah, so the pros, I mean, I guess it intuitively makes sense, right? You buy things for less than they're worth, right? But
only logical approach.
That does involve a lot of work, right? So that's you've got to scroll through huge amounts of data. You need to tear companies right down to the nuts and bolts in terms of analysis, and that can be just really hard to do. I mean, I remember who's the guy in The Big Short, Michael Burry. He was almost the only person who was kind of prepared to read through the 200 pages of mortgage documentation or whatever, and that's how he kind of constructed his thesis. I think it requires huge amounts of patience, not only in time but also in kind of work and the ability, which is tough, which is when you've spent so much time looking at a company expecting that this is going to be the one that you're going to buy, and then having to turn around and say, well, actually, this is valued appropriately, and we need to move on to the next candidate. David, you wanted to come in.
Well, only to say Warren Buffett was well known for taking volumes of company reports on holiday with him, and sifting through them, the kind of mountains of paperwork. So when listeners are on holiday over the summer and they're around the pool and they see someone with a couple of feet of paper next to them, you can be sure that's probably a value investor.
Yeah, and also I suppose from what you're saying, but what you're both saying, you've got to have be a bit of a contrarian, haven't you? Because you've got to look at something and think, no, everybody else is wrong. I think there's something here. But also, I guess the challenge is, if you're a value investor, you don't hold those companies then once they do fulfill their potential. You have to sell them, don't you? And that's a challenge. And then you've got to go right back to the beginning again.
Well, I was going to say, it's a really important point, Sarah, that we shouldn't gloss over, because value investing directly challenges the efficient markets hypothesis. And that's why the development of things like the Farmer-French three-factor model and everything that sort of came, the various augmentations of these models are based around this idea. Because the efficient market hypothesis says that it shouldn't work in principle.
Yeah. So what you're saying is, if a company's priced at a particular level, that is correct because the markets have worked out that is the right price for that company.
In theory.
In theory. Okay. All right then. So that's value investing, which brings us then, we've touched on it already. I've already mentioned it. Quality investing. How does that differ to value investing?
Well, I think for me, quality investing is based on the idea that good companies tend to outperform. So yeah, again, good companies, quality means different things to different people. I think quality is one of those descriptions which is just really means different things to different people. But what I'm describing it as those companies with high levels of profitability. So you're looking at high operating margins, high return on equity, also strong cash flows. So that's evidenced by things like big dividend payouts, big share repurchase activity, and really that comes down to this idea of moats, this idea of companies with a moat, with barriers to entry, whatever you want to call them. But it's the reasons really behind why can they earn these things, and it's because they might dominate a certain industry, they might have a certain level of technology which is just unsurpassed by their competitors, etc. So that's quality investing. So
that sort of suggests to me then, we talked about value investing, how that often doesn't do well during an economic downturn because those companies might end up being priced for extinction. Quality investing then suggests that that's a better strategy when we're going into a contraction or a downturn.
Yeah, that's certainly the evidence does bear that out, that when economic conditions are deteriorating, you do frequently see a flight to quality. So a flight to these kind of companies that the investors know will be able to make it through that economic downturn. But clearly that works on the way back up, right? So these companies might tend to lag, that economic recovery, lag those much more cyclical, much more distressed companies as they're coming out. So yeah, but in a kind of a period of economic deterioration, you would expect quality companies to outperform. But I think just looking throughout the cycle, quality it's been one of those things, again, going back to the efficient markets hypothesis, this shouldn't work. Right, good companies shouldn't really persistently outperform, but you do see that it's been one of the most persistently strong factors that has generated returns for investors over the last couple of decades.
David, you talked about how value investing, you can sort of trace history back to 1920s. What about quality investing? Does it have a longer track record?
Well, I mean, there's some of those same names that I mentioned, like Warren Buffett. They've exhibited style quality investing as a style. I think it's only really been encapsulated as a concept more recently. Doesn't quite, but its principles go back a long way. I kind of think of it that point that Howard made about it shouldn't work. I kind of think about it in terms of how I think about the US dollar. If the world economy is good, dollar rallies. Even in a crisis, dollar rallies. Even if it's an American domestic crisis, dollar rallies. It's like these idea of moats and stable, very robust balance sheets and dominance is a kind of all-weather principle. But I think that I think it's with the number of sort of asymmetric shocks we've had more recently, quality's been elevated up as an investing style. It was for the last decade and a half, it was growth versus value, and then bring COVID in and a few geopolitical shocks, and people are interested in quality again as a concept.
Okay, so this sounds great. Why doesn't everyone do quality investing? You buy good companies, they've got solid returns, they've got strong balance sheets. That's the way forward, isn't it?
Well, yeah, I mean, these kind of companies will be uncontroversial investment choices. It's not like the value investor who brings an idea to their investment committee and everyone looks around at each other saying, what, really? If you would bring along a company that everyone's heard of, everyone's realised, that's a great company, what a great idea. So they can be relatively uncontroversial choices. However, these companies will be trading at premium valuations. So you need to pay up for the kind of characteristics that we talked about. So there's always going to be that question, am I overpaying for this? And I think that it comes back to what will make it challenging is confirmation bias. So for those, I'm sure people know what confirmation bias, but this is this idea that you'll find lots of evidence or lots of opinion to support what you're doing, and that will make you feel good, and you make you feel quite reassured that you're buying companies that a whole raft of analysts will have buy ratings on, but so it's easy to fall in love with these companies. But I think that can be the pitfall, which is good companies can turn into bad companies. And there's no guarantee that these companies, even if they've done well in the past, will be able to sustain those kind of advantages. So that's always going to be the challenge. Is am I missing something? Is the valuation as high as it can go, or is this the peak?
Yeah. So essentially, then we're saying that the sort of the argument against quality investing is that you are going to be paying a bit more. But I think to quote Warren Buffett, did he say it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price? He's full of them, isn't he? But anyway. So the risk is that you maybe overpay for something. You can't guarantee today's quality company might not be tomorrow's quality company. And I'm sure, without naming names, I'm sure if we looked at the S&P 500 20 years ago, they would be the top 5 companies. You would say, absolutely solid quality companies. Fast forward 20 years. I don't know. I don't have the stats in front of me, but how many of those companies that were in the top 5 of the S&P 500, let's say 30 years ago, are no longer, they might not even be in the S&P 500 anymore, let alone in the top 5. So today's quality might not be tomorrow's quality.
Yeah, I think that is the challenge, isn't it? Yeah. You've summed that up incredibly well, Sarah.
You're too kind.
I've got nothing else to say. You said it all.
I think it's a good. I mean, listeners will fact check me on this, but I'm racking my brains. I think probably only ExxonMobil is the only company that would still be in that rank. But we'll have to take that one offline, I think.
Yeah, and obviously we're not recommending individual stocks when we talk about company names. I mean, that's a given. All right then. So we looked at value investing. We've looked at quality investing. Now this one, the third one, this seems like the easiest one. Is it? I don't know, but maybe because it's the easiest, it's a bit of a challenge if you're paying someone lots of money to make investment decisions for you. I don't know whether I want. Are you getting value for money if you're going for momentum investing?
It's hard, right? Momentum investing. So momentum investing is those stocks that perform well in the recent past, and again, going back to our friend, the efficient markets hypothesis. This shouldn't work, but we know that stock prices tend to move in trends. They can move in uptrends, sideways trends, and downtrends. And therefore, stocks and markets that are hitting new highs tend to go on and make new highs. And yes, it is easy. I mean, to your point, it's you don't have to waste time with financial statements and any of that nonsense. You just look at a price chart, right?
Yeah, exactly. What could possibly go wrong?
Yeah. So, let's look at the challenges, right? It's incredibly hard to buy stocks that have gone up a lot. And when we talk to clients and we recommend individual stocks to them, this is a common pushback. I mean, this whole idea of buy low, sell high is kind of programmed into all of us from birth, it seems.
That's value investing, isn't it, basically?
That's right. And it's really difficult to shake off. I mean, talk about behavioral biases. I mentioned confirmation bias before, but let's talk about anchoring, right? When we look at a share price chart, we look at where is the bottom of the chart, and then where is it today, and that doesn't make any sense. I mean, market doesn't care what the price was a year ago, 2 years ago, 5 years ago, but we're kind of programmed to say, all right, well, it seems to have gone up a hell of a lot. So, but surely, that's kind of at the top. So this is always the challenge. You always feel like you're the last person to get in. I guess the other thing that I was going to talk about was, I remember one of the last time I came on Need to Know, and we got onto the subject of momentum. I remember Alan saying, "But it's so embarrassing." This is one of the investment styles which is like derided by other investors. As you say, value investors who spend all their time on analysis, just so dismissive of momentum investing. And so I guess you've got to almost be a little bit of a contrarian to engage in momentum investing, right?
I think that's an interesting point, because there's a lot of, again, there's different types of momentum investing. There are people that draw shapes on charts and think those shapes represent things, which I philosophically have a big issue with. But then, you look at its origins. Momentum investing was kind of emerged at that period where big data and the more computational driven strategies started to emerge in markets in the 80s and onwards. And I think that, let's just put this into context against other styles of investing. I think it's fair to say that momentum investing is high risk, high return compared to some of those other strategies. And whether he said it or not, whether it's apocryphal, Ed Sekoto, I think, said, and Howard and I were talking about this previously, the trend is your friend right up until the end when it bends, or words to that effect. And these kind of strategies it's not just about following the trend, it's all about limiting your losses. Because as I said, they are much higher risk strategies that can move against you just as quickly as they helped you.
Yeah. If we're going back to the original, when we were talking about value investing, and I mentioned meme stocks, and the one that's featured in the film, is it fair to say that started out as value investing and it ended up being momentum investing because people were just piling in because they could see the price was going up and up and up? Is that perhaps, maybe it's a little bit of an oversimplification, but is it fair to say that that's an example of where value investing became, because of a social media kind of craze and a Reddit chat board, that actually became momentum investing?
Well, I definitely want to hear how Howard interprets that. But I think that's a good point there, that companies can start as maybe growth companies and then evolve into quality companies, and maybe even then back to value companies. No one company holds a particular style over its lifetime.
Yeah, so I was gonna make that point that companies evolve. They go through being, as you said, from being quality companies to being value companies, and I think that's certainly what happened in what has happened in the meme stock craze. When it started out, these are value companies at real distressed valuations, and then they kind of very quickly got to momentum stocks, and and then at that stage, probably all the value investors are kind of long gone, and then they're all replaced by the momentum crowd.
Yeah, we've talked about how when quality investing tends to do better, at what stage in the economic cycle, and value investing. What about momentum investing? Is there a particular part of the business cycle where momentum investing tends to work better? And is it kind of, I mean, I don't know, is this it's been in vogue for a while, I think, hasn't it? Is it fair to say?
Yeah, so I would say like kind of market environment that we're seeing today. So when markets are at relatively high levels, so they're rising, and then momentum strategies tend to do quite well. And I think the way I kind of would explain it would be thinking about investor psychology or investor mood. So when markets are all near all-time highs, then there's lots of euphoria, lots of confidence. These kind of feelings, emotions tend to help momentum. Whereas if you contrast that with when markets are low, people are fearful, people have made losses, people have become just very focused on safety, capital preservation. You wouldn't expect momentum stocks to do very well in that kind of environment, unless it's momentum as in, those stocks that have performed well or been more resilient. And certainly when you have another kind of environment where it's very difficult for momentum to perform well is when you have, I would say, volatile, what I call whipsawing markets, but this whole idea of markets going very up and down, not really having a trend, lots of volatility, lots of rotation between sectors. So there isn't a kind of a group of companies leading the market, which is obviously very different from what we're seeing today. So we have talked on a number of occasions about a certain group of stocks, which are have led the market higher, and momentum investors are kind of all over that group, and as a result, momentum as a theme has performed very well over the last 12 months.
Yeah. Has there been any analysis? Is there any data out there that could show that over the last, let's say, 30, 40 years, one of those strategies has worked better than the others? Come on, tell us. We need to know.
That's so hard because often the day. Well, it's how do you define some of these things? I don't know. It's so hard. But I think that what I would say is that there is certainly evidence to suggest that styles perform better in certain environments. So I think there is an argument for a flexible approach rather than being kind of wedded to one approach. However, that kind of goes against how a lot of investment managers operate. If you think about a lot of Coutts, for example, buys a selection of third-party funds. Wealth managers like us might buy a selection of managers. So they might buy a value manager, you might buy a quality manager, you might be buying a growth manager, just to kind of hedge your bets, because you don't know with one certainty that one style will always outperform the others. So that's kind of how I'd answer that question.
Yeah, I think that's 100% right. I mean, look, everyone knows in recent years it's growth stocks that have worked. That's technology, consumer discretionary, healthcare. But I think when I think about the bigger mega trends here, there's investor optimism towards companies benefiting from structural shifts in the economy, and that might be represented very well by growth companies today. But I think stepping back from that and looking at, what's the rate environment we're going into structurally? Are we going to settle at a higher interest rates? And when it comes to different types of companies and whether they carry lots of debt or not, and whether that debt's floating or not, I think the rate environment obviously has a big bearing on that company's financial resilience and performance. So I think you can, like Howard said, look at the kind of regime you're in, look at the market backdrop you're in, and look at 3 periods of history and look for similarities and differences. And then you can make a kind of informed decision on that basis.
Okay. So essentially what we're saying is, we looked at value, quality, momentum investing. We're saying they're all difficult. None of them are easy. They all work, but at different times. And they all have their own particular challenges, whether it's, it's hard buying. You've got to do a lot of research if you're going to look at perhaps value or quality. Momentum is a little bit easier, but it's difficult because you're buying a company and you're questioning whether it's already peaked. So that's tricky. And we're saying that, that there'll be times when each one of those styles will work well, and there'll be times when they won't work so well. And so what we're saying is, maybe, I don't know, choose the one that works for you, or combine them. Is that the sort of simple solution?
I would say so. So, I think someone told me once, early on in my career, that you need to find a kind of investing style that suits your personality. So if you're happy being argumentative and cynical, and maybe value investing is for you. If you like to kind of go with the herd and not be too controversial, then probably be a quality investing. If you're kind of naturally a bit of a gambler, high risk, high return, maybe momentum's for you. Maybe that's the answer, that maybe we should all try to adopt an investment style that suits us.
I couldn't put it better. That's a perfect summary. Thank you, Howard. Thank you, David. A reminder that the views expressed in this podcast are not intended to constitute investment advice, are accurate at the time of recording, and are subject to change. Thank you, everyone, for listening. To make sure you never miss any future episodes, make sure you're subscribed to Need to Know via the usual platform wherever you get your podcast from. And obviously you can listen to previous episodes as well. We'll be back next week with more Need to Know. Until then, bye for now.